Welcome everyone again to this ShareCafe Hidden Gems webinar. Not much of an intro today other than all eyes are on the US election, and it appears the market might be a little bit tired. We've seen a lot of good announcements by companies and no follow through in share prices. We've seen several IPOs that are kind of falling below issue prices. So we might be in for a long summer given how 2020 has played out. This week we are discussing real estate, beauty and health products, sustainable cellulose fibre and uranium. If you want to ask a question, just type it in the Q&A box provided. For advisors, CPD accreditation will be provided if you watch the entire event. Okay, first up, let's get straight into it. We have Star Combo Pharma, ASX code S66. It's got a market cap of around $42 million. The company is a leading manufacturer and distributor of premium health and natural beauty products. The company's curated health products are made from natural ingredients backed with scientific research and development and the highest standard manufacturing practices. We have Sue Zhang with us, who is both the founder and the managing director. Sue, thank you for your time. Over to you.
Tim, how's everyone? I've just turned on my camera. So thank you very much for having us on. We can just jump across to the company snapshot. Next page, thank you. Now, to give a little bit of a snapshot on Star Combo Pharma on a high level, we are a Sydney-based manufacturer and distributor of vitamins and beauty products. We've got our own capability in the manufacturing segment, along with our own branded product portfolio, as well as a retail arm. So we've got quite a diversified business portfolio going from end to end. Now, what we can see is that our revenue for this year, for the current financial year, is at 38.8 million, and we are up 81% on financial year 19, which is a very remarkable result we've achieved so far. Our EBITDA for the current previous year's comparison is that we are also up, currently now at 1.8 mil. Star Combo Pharma, although it has been listed on the stock exchange at 2018, so we're still fairly newcomer in terms of being a publicly listed company. However, we've had a long-standing continuous operation for the past 16 years, going from a very small distribution type of company, then adding on to a manufacturing arm, and slowly building up the portfolio that we have today. Next slide, please. Now, what we can see is our current capabilities include the contract manufacturing facility, which is currently at about 25,000 square meters, as we recently completed the acquisition of the adjacent land to the current facility, and we will be building on that. Now, the facility that we currently operate across is actually a TGA licensed manufacturing facility. Now, what that actually means is that as a full scope manufacturer, we are able to make therapeutic goods such as fish oils, glucosamines, to your more unique herbal-based medication. So we've got a very, very full manufacturing scope in our current facility. Now, on top of that, you would have picked up in the previous slide that we do have a very diversified portfolio. So we also do have a retail as well, which is under the OSTU banner. Within the OSTU banner, we've got a separate online and offline distribution, whereby the offline contributes minimally to the top line, and most of the sales completed in the online platform. Now, through there, we distribute a range of vitamin wellness products, including your things like your UGG boots, milk powders, etc. So quite a diversified range of products, mainly going from B2C channels, so going from business to consumers directly. Next slide, please. Now, what we would see is that for the past 6 years figure, now you can see that we've had quite steady increase in our business overall. In the last financial year, we had a total of 38.8 mil revenue. Now, the breakdown is 66% from our retail side, 19% is from our contract manufacturing side, and 15% is from our own branded product. Now, with the breakdown activities for this year, it's worth mentioning that in May, earlier on in the year, we've actually completed a 33.32 million placement via a Chinese Shenzhen listed company called Golden Max. Now, they currently have a pharma division in China who's very engaged in distribution and manufacturing of their own branded product, largely in the herbal space. Now, when we come into the year of 2020, I think everyone talks about COVID-19. And I think that would resonate with most of the companies. Now, luckily for Star Combo Pharma, we've had very minimal COVID-19 impact to our operations. Because we operate in the healthcare space very actively, what we've actually seen is that there are certain demand increases in immunity boosting product. Now, when I talk about minimal COVID-19 impact, what I'm really proud to say is that through the year 2020, we've had no changes to our current staff. So we haven't trimmed down on anyone. In fact, right now, we're actually recruiting for new members to our big family. And also in terms of the operational perspective, we've had no disruption to the current workplace. Everyone is still operational on site. However, we've obviously got COVID-19 measures in place, including extra sanitizing stations, etc., like signing, and then having the work as a COVID-19 safe place, and then having an office off the site. But we've had 0 shutdown days due to COVID-19. So that's something I'm very proud to say that we've achieved over the year 2020. Now, in terms of the current business, we are actually still facing a growth, which is extremely positive. Now, overall, we've had 14 new private labeling clients, which is worth approximately $1 million in revenue that we'll bring through. And we are currently also expanding the current manufacturing facility, which is the large core to bring manufacturing back on shore, and then keeping that domestic supply chain available through this period of time and moving forward. Now, for our Q1 activities next year, what we're striving to achieve is to further expand on our private labeling side. I'm quite proud, again, to announce the work that we have achieved in the last quarter, and that is signing up a supply agreement contract with this warehouse. And also, we expanded our capabilities to also cover liquid product manufacturing. So that would cover your things like your DHA drops, vitamin D drops, etc. And as mentioned previously, we have completed the acquisition of an adjacent land currently to the 171 to 177 Park, Smithfield. That would be an additional new site to our current facility. So this gives a better snapshot onto our current business model. And previously, I have mentioned that we are a very vertically integrated company, providing end-to-end healthcare benefits. Now, going through this gives you some detailed snapshot as to exactly what business unit functions are. So the contract manufacturing division falls under Star Pharma, and we are a fully TGA licensed facility to be able to do a full manufacturing scope, covering your soft gels, your tablets, your powders, and also your hard capsules for the very recently added line into the liquid space. Under StarCombo Australia, this is where the distribution arm comes into place and also where our own in-house branded product is held under. Now, that is the wholesale side. So predominantly we deal from a B2B perspective, which is business to business. Moving across to Australia and Koala, more functions. These opens up your B2C channels, so your business to consumer outlet. Now, through this platform, majority of the sales occurred in our e-commerce platform, and then with certain divisions into our retail store. Again, the two physical store is currently based in Sydney. Now, in terms of the our activities with the China distribution, we actually have an in-country office in China, and currently we've got 11 products that are registered under the CIQ license for distribution into offline arms. Next slide. Okay. And then giving a detailed overview of PHARMA, which is our manufacturing division. We currently sit on 15,000 meters of the purpose-built facility at 171 to 177 Park Road. We are continuing to expand that. So with the new site addition, that will become a 20,000 square meter facility, and we are building on that. Through the year of 2020, what we're quite strong in is new product development. So what we're able to do is provide a brand concept. So for example, you want a particular product with a certain benefit, but you don't know what formulation to go. Now, we are the expert in this field, and we have done the commercialization of 26 new products based on marketing concept in 2020. Our facility at the moment, we've actually also completed the building of a milk powder blend and pack facility, which was completed in August this year. Now that facility sits on the current line and is currently export ready and is currently registered under the DAWR. Next slide, please. To give a little bit of a background onto our branded product distribution under StarCombo, what we have is 4 different brands going across into different target market segments. Now, what you can see is that we have 2 vitamin brands and then also 2 beauty brands. Their distribution channels and target market is very, very different. And I'm not going to go into the detail of getting that breakdown, but it's pretty much covered in the slide. Next page, please. Now, the e-commerce platform, the Australasia part, we currently provide across 5,000 product lines. So it's a very, very diversified portfolio. Across that database, now what we have is that we've both got StarCombo products, we sell other products as well. So it's definitely not something just targeted into our own brands. Now, with the retail presence, we've got one in Carlingford, which is northwesterly, and then another one in Ashfield, very much in the west Sydney. Our new customer acquisition rate is about 15%. Growing into the future, we want to focus on 6 pillars. We want to focus on our research and development side, include our service offerings, maintain our price competitiveness by growing with economy of scale, and also expanding the current site. Next slide, please. Now, this slide covers a little bit of our strategy. However, I am really mindful of time, and I want to leave some questions for questions and answers. So I might wrap it up over here and then open it up for any further questions.
Thanks, Sue. I realise you have a lot to get through there, so but sometimes Q&A is good. Can you tell us a little bit more about the substantial shareholder? I noticed that management and Golden Star own around 64% of the register, and I suppose the issue is that can potentially be a conflict for fund managers who want to see a larger free float.
Oh, absolutely, Tim. That's a very good question. And in terms of that held up, management actually no longer have a 65% shareholding. There's about 30% shareholding from management. Now, earlier on this year, in May, we had a private placement completed by Goldman Sachs. A large percentage of our business portfolio revolves around a clear China market strategy. So rather than finding distributors or agents or whatnot, what we find is that you need to have the right partner, the right strategic partner to be able to grow that space properly. So for us, Goldman Sachs was the right partner to bring on board. Now they've contributed quite significantly into the board in the past few months, and they currently is a substantial shareholder with over 30% holding. And they brought in 33.32 mil to the business this year.
And why manufacture in Australia? Is that because there's that, that image and branding associated with the clean, healthy living in Australia? Is that why you manufacture here as part of selling those products back into China?
Yeah. So our manufacturing facility is actually TGA licensed facility. We are expanding the manufacturing operation to cater for growing demand in the healthcare space. So vitamins, we're still seeing a clear demand. It's just that the product that consumers are asking for is a bit different. Further to that, the local manufacturing area, I think, will actually experience a downside subsequent to COVID-19. Now, the government, the Morrison government also has said very, very strongly that, there's a heavy investment into the manufacturing operations. And we believe that we do need to bring manufacturing back on shore. So to clarify that, we're not just manufacturing for overseas business. A lot of our current manufacturing partners that we have, so the brand owners who manufacture with us, they are domestic brand owners and they're domestic players. And we want to cater to that market, and we believe that the demand will still be very, very strong, especially after this COVID-19 sentiment.
Okay, and we've got time for one quick question, one quick answer, if you don't mind. China, there's a lot of trade conflicts with certain commodities. Can that affect your business?
Look, I think we're in a very, very good space. And to an extent, I think, yes, it will. It will affect not just our business. I think it will affect all business in general because, potentially that's one of the largest markets in the world. But what we have is that we have a sound strategy to target that market. We have an in-house strategic partner who knows the market quite well. And then on top of that, we also focus on the local market, the domestic market. It's not just as though 90% of our product are on export. In fact, 90% of our revenue comes from domestic players. So I think for us, starting by PHARMA is in a sound position to overcome that. Now, in the short term, I think, yes, it will affect us in some way or form, but definitely long-term wise, we need to recognize that market, and we've got a sound strategy behind it to be able to back that.
Great. Thank you, Sue. Thank you for the Star Combo story. That's all we have time for. Okay.
Thank you, Tim.
See you again. Next up, we have Marinka Energy, ASX code MEY. The company has a large land position in the globally recognised Orongo uranium province in Namibia, a country with an established and long-running uranium mining industry. We have with us Murray Hill, who's both the Managing Director and CEO. Murray has 36 years experience in the mining industry. Murray, thanks for your time. Nice backdrop there. Over to you.
Thanks, Tim. Yeah, I'm sitting in the desert in Namibia, as you can see. It's a little bit warm. We need a little bit of drink of water. Yeah, no, it's a nice virtual background, isn't it? What an exciting time to be in uranium. We're seeing that demand is outweighing supply for the uranium, which is a fuel source for nuclear reactors. And we're also seeing that there's a lot more talk around carbon emissions and cost of power and reliable baseload power, and nuclear gives all of that. So there's only, you know, with COVID kicking in, about 40 million pound have been taken out of production this year. So subsequently, we're seeing a huge gap between production and demand. And that's set to continue for many years to come unless things change. And the only thing that can change is production has to increase. Now, there's no incentive for producers or with care and maintenance, in projects in care and maintenance, or explorers like us to get into production because the uranium price is too low. We can't make money. So there's only one way for the uranium price to go, and that's up. And, you know, we expect that it will happen on the basis that, you know, we've got to meet demand from these nuclear reactors. So if you can go to the next slide, we've developed a uranium company in counter-cyclical. And what we've done is through the low price times, we've acquired assets that met a certain criteria, and we've built up a tenement position in Namibia. As you said, we've now got the largest tenement position in Namibia and in the Orongo region. And this is all underpinned by upgrade beneficiation process. So we've been fairly quiet through that period of time, and we haven't been spruiking what we've been doing simply because we didn't want to tell everybody what we were doing, because our peers might trump us in some areas. So now is the time to start telling everybody what we're up to, and we've been delivering on that strategy. We've picked up 48 million pound of high-grade assets in Australia, and we've also got the largest ground position for nuclear fuels in Namibia, and we've explored 2 of those EPLs of the 10 or more we've got, and 2 of them have come up trumps with uranium. So we're very excited about what the future brings for exploration, and we're very excited about how the company can develop through this expected uranium price rise. So upgrade is what's lowering our cost base and providing us the incentive to explore, and it's something that others don't have. So if we can just move to the next slide, we can show you the map of Namibia, and this is the Orongo region in particular. Rossing have been operating here since 1976, continuously operating for 44 years. And I'll take you back to 2007, when the uranium price jumped to over $130 a pound on an issue with utilities not buying sufficiently before that, a lot like we're seeing now, utilities not buying to feed their reactors. Marinika and many other shareholders of companies with exposure in Namibia made a lot of money last time the uranium price rose, and we expect the uranium price to rise again soon. So what we're targeting paleo channels, which are secondary uranium deposits, not like the Alaskites of Rossing, but where the uranium's leached from the mountains over millions of years and run down towards the coast in old river systems, old paleo channels, and deposited when conditions are suitable. So we're looking at deposits that are less than 30 meters deep, really shallow, easy exploration, low cost exploration. So that's what we're focused on. So we've got our 61 million pound uranium resource at Marinika, our namesake project we had when the uranium price was $130 a pound last time, and we were 130 million market cap. Now we're sitting around the 12, 14 with a hell of a lot more assets in Namibia and Australia, and a lot more blue sky potential and exploration. So we're excited about what's ahead of us. And if you can go to the next slide, we'll just show you the Namib area down the southeast of this Orongo region. Next slide, please. Hello. There we go. So in the Namib, we got a continuous land package of tenements. We've explored at Hiderbeb and Koppies. It's a province that General Mining explored in the 70s and early 80s. General Mining morphed into GenCore. They found Langer Heinrich, they found Tumis and Oceananus, all from sort of radiometric footprints from surface. And they then highlighted a lot of other areas within the EPLs we've picked up that are high exploration potential. However, they left the country before they could explore these. And what makes these attractive for us is that General Mining have got exploration targets on them. And also they're upstream in an old river system of known deposits. So the uranium had to flow through these tenements we've got before it's precipitated in these other deposits. So hence we're expecting that they will also precipitate upstream and where we're targeting. So just go to the next slide. I want to talk to you about Koppies, which is in the middle of this slide. I'm sorry, I'm seeing a huge delay in the slide moving forward. I don't know whether you're hearing me. But Koppies is an area that we targeted as our first EPL that was granted to us. We explored it with a little bit of drilling to follow up what General Mining had done. We found a lot of uranium there, and then we started to use Because we don't see a surface footprint in this area in terms of radiometric signal on surface, as an example, the second drill hole on this slide has got 1 metre at 7,000 from 1 metre deep. And this drill hole was only 4 metres deep. So it's got a very high radiation coming from it, but it doesn't reach surface. So the radiation on surface would be lower than what's coming out of your granite benchtop in your kitchen, or lower than what's in the prefab concrete wall in the factory or warehouse you might have visited. So it's very low radiation at surface. And so we've had to use ground-based geophysics to get identification of where the channels are. So that just picks up the difference between channel and bedrock, or paleochannel and bedrock. So that enables us to delineate the outline and also indicate the depth of the channel. So we've gone and explored with drilling. We've only drilled about 40% of the paleochannel out, and then we sort of looked at it and went, we can go and spend another $1 million and drill a resource out, or alternatively, we can go and do something else for that $1 million. And if you go to the next slide, we will find that we spent $130,000 to explore and find Hirabeb. Hirabeb is 15 times the size of Copies in terms of the surface area of the EPL, and the channel we've located is wider than the English Channel, to put it in some sort of perspective. So, and we've identified mineralisation over a 30-kilometre length. So we know that there's a lot more channels there. We also want to find out where these channels are, what the depths are, and also where we might find traps. So you can imagine an old river system. The solution flows down and the water flows down. It might hit a dam. It might hit some sort of diversion that's got to go around. So they're sort of what we would call traps, where we believe that there's probably higher grades of mineralisation over a larger area. So the fact that we've got mineralisation in the channel tells us there's a high prospectivity of finding a lot of deposits, or larger deposits on this tenement. So, and a lot more of that to explore. So really excited about what we've got in future there, blue sky, but also that's 2 of 7 tenements we've got in that area. So some of the money that we're going to get from capital raising coming now, we'll be putting into maiden exploration programs on the other 5, but also, Hirabeb is a fantastic target for us. So now moving away from Namibia back into Australia, and what we've got is we've picked up these assets in December last year, and we purchased them because one thing is we paid 4 cents per pound of uranium in the ground. Now, when I consulted to Extract Resources on the Husab project in Namibia back in 2011, they sold it when the uranium price was $55 a pound. They sold it for $4.50 per pound in the ground. Now, I'm not suggesting we're another Husab or another Extract, but what I'm saying to you is 4 cents per pound versus $4.50 per pound. If we see the uranium price move as we expect it to, these assets won't be worth 4 cents a pound. And they definitely won't be worth 4 cents a pound to us, because what we've done, we just announced last week the Angela deposit, 31 million pound at 1300 ppm, 25 k's south of Alice Springs, so near infrastructure, a great spot to be. With the impediment to developing that project has been the acid consumption for the leach. We've gone and reduced the acid consumption from 104 to 24 kilos per tonne. That's 80 kilos per tonne. The acid price delivered to site is 40 cents a kilo. You don't have to be a good mathematician to work out that 80 times 0.4 is $32 per tonne of ore. So that's a huge saving. And through a $20,000 test work program, we've been able to identify that. So we're now sitting back and with those results, trying to work out where we take this project to the next stage. But that's a sort of an example of how we can add value to these assets. Minerva has got 29 drill holes that drilled in back in 1978 with intercepts of greater than 10,000 ppm or 1% uranium. They're exceptionally high grades. And they've also gone and drilled, assayed 2 holes for gold. One, they didn't have uranium in it, so I'm not sure why they assayed for gold. The second one had a 19.2 grams per tonne gold intercept and a 2.3 grams per tonne gold intercept. If we're a gold exploration company, our shares would be rocketing on the basis of that gold based on what others are getting. So we're excited about what that does for us, and we will need to go and understand how much more gold's there. So once our Premier allows us to move around the country and get into Northern Territory, we'll obviously go and have a look at that and work out where we take it next. So Ubergum is another one. You look back at the 2015 annual report for Paladin, they had a resource of, we can't state the resource, but they had it in there. And we add those pounds to our baseline. Our purchase price was 3 cents per pound in the ground. So very exciting prospects for us on those. Upgrade, we've mentioned it. To us, it's a differentiator between us and our peers. It's a process we developed in-house in conjunction with CSIRO. It rejects greater than 95% of the mass prior to leach. Leach is the highest unit cost operation in any processing plant. So what it does is it gives us optionality because it produces a low mass concentrate of high grade. We've taken Marinica from 93 ppm to 5,000 ppm, 50 times upgrade. We've lowered the CapEx and OpEx by 50% compared to conventional, and it gives us optionality, which means we can either produce yellow cake on site, or we can develop a smaller project and take a concentrate off-site to someone like Rossing, and they can leach and refine it. So that lowers the CapEx further again down to 25%. So a real clear differentiator between us and our peers, and it really is something that adds significant value to us. So on the next slide, we look at, we've got a small board, we've got technical expertise. I'm the champion of the upgrade process. We've got skin in the game, and directors and management at 5.8% of the shares. So we've committed to the company. We've got, we're similarly aligned to shareholders. We've got a low number of shares on issue, 143 million. Usually you see 2 billion there for a lot of uranium companies. We've got some cash in the bank, but we are looking to get some more money in to advance our exploration efforts. So in summary, in the next slide, you'll see that we've got these large-scale Namibian tenements, the largest in the country. We've got successful exploration. We've explored on 2 tenements, and we've got success on both. So we've got the track record there already, but we're not resting our laurels. We've got a lot more work to do in Namibia to add value to shareholders. We've got these assets in Australia we've picked up for a song that we can add value to. Both of those, high quality assets in their own right. When you add upgrade it to it, it takes it to the next level. So really, we've got tremendous leverage to the uranium price, but we've also got leverage to what we're actually doing with the company and building the company. So really quite exciting times for us. And now we've quite often talked to our supporting broker in Melbourne that we're probably the least talked about uranium focused stock on the ASX with the greatest potential. So we're really excited about where we're at, what we've achieved, but we've got a lot more value add to do to our shareholders, and with an excitement in the nuclear power sector at the moment, and a bit of tailwinds behind uranium, we can see some really substantial moves in uranium companies. And 20 years ago, back in 2007, there's 500 companies that had uranium assets. Now there's less than 50, and half of those are supported by government. So there's a very few number of good quality uranium companies that investors can get into, and we think we won. I'm a shareholder, and I'm certainly putting my money into this capital raising. Thanks, Tim.
Thanks, Murray. So, you talk to the uranium price and can kind of crank things up when the uranium price improves. What are the catalysts to drive the uranium price higher?
Well, uranium price it's the nuclear reactors need to buy fuel, and fuel is uranium, right? And they're depleting their stocks down now. If they don't start buying, right, soon they're going to run out of stocks in a number of years. Now, it takes 2 years to go from yellow cake through to nuclear fuel rods, right? So there's a delay there. Now, there's no incentivization of supply to come on stream, and there's a deficit in supply demand unless uranium price is higher. So that's the catalyst, the consumption of uranium in nuclear reactors, and the fact that there's production is not going to increase because you can't make money. Cameco shut down the largest uranium mine in the world. They've just started it up again, but they're buying on spot and selling into their contracts. And a lot of these contracts are dropping off. They might be selling them at $50 a pound, and the uranium price is at 30. So they're not going to renew contracts at $30 a pound. You're not going to waste a valuable resource where you barely make a cent on it. So the catalyst has to be utilities buying and pushing the uranium price up to incentivize new production.
We've got a question here from a well-known resource analyst. Reactor developments often get delayed. Are you seeing a backlog of past announcements finally coming through to start securing long-term uranium supply? And could uranium users be JV development partners?
So the nuclear reactors, for a period of time when we started to move towards renewables in a couple of countries, they took a lot longer. So it began to get a reputation of taking 7 to 10 years to build, but that's come down. And we're also seeing, as an example, say France has 70% nuclear power. Germany's gone towards renewables. Germany's got double the power cost of France and 10 times the carbon emissions. So we know that that side of it's not working. Look, from our point of view, are we going to be JV'd? Are we going to be bought out? Are we going to develop? We've estimated it's going to cost about $50 to $60 million capex to build a 3 million tonne per annum plant producing 1.5 to 2 million pound per annum, which is a good sized plant. So, you know, for a company like us, that's well within our reach. If we needed 400, 500, 800 million, well, that's just not going to happen, and you need Big Brother. But so we'll work towards developing. We may get taken out along the path, but we certainly believe that we can become a producer and you know, supply into some of these reactors that need it. But also SMRs are becoming, you know, a lot of talk about small modular reactors. They vary in size from, you know, 3 megawatts to 300 plus megawatts, and they're built in a factory, moved to transported to site. They can supply power to a town, you know, a remote town. They can supply to cities, and they can be modular. So you just put one after the other, and you know, they're going to become a very important part of our future power generation.
Great, Murray. That's all we have time for. I'd love to follow up on the subject with you on via ShareCafe, so I'll get in contact. But thank you for your time.
No worries. Thank you, and thanks for everybody for listening.
Next up, we welcome back the agency, ASX code AU1, market cap of around $12 million. I think you see a lot of their signs and front gardens all over Australia. The company was established to bring together the most experienced and highly regarded group of people in the real estate space, and has created a model that is more responsive in today's property market. We have with us Paul Neodone, who is the Managing Director. Paul, nice to see you again. Over to you.
Thank you, Tim. Thank you for having me back. I think I'll probably follow on the same sentiments that the previous speakers have been on. The main point I want to make today is that I think we're now well placed for the market to re-rate us. Since it was the Melbourne Cup on Tuesday, I'll use racing terms. At the end of the last quarter, I think the company executed a trifecta, and that was strong results. We re-rated our debt position and our balance sheet, and we also entered into an exciting joint venture with Managex. So we're here on the executive summary. So just to recap, you know, we've only been listed for just under 4 years, and in that time, we've created a national presence that's growing. We're cash flow positive. We're now EBITDA positive, and we've got a strong balance sheet. We've built a full service firm, but more importantly, we've got a platform that's ready for growth and scale. Another point of difference is we have 2 brands in our company that are there to reach different markets and different agents. We also have a fully integrated company. So we do residential sales, we do mortgages, conveyancing, property management. And so we try to capture the whole value proposition in the sales cycle. And we are different, and we're challenging the traditional way of doing real estate, and it's starting to cause an effect. But we can have a look at just some of the highlights in terms of the results. We finished with a $2.6 million EBITDA, which, you know, followed from a 4.25 loss in the previous year. So it was a great turnaround by the company. Our revenue's growing, our commissions are growing, our listings number are growing. Just as exciting is the value of exchanges. So, you know, we nearly did $3 billion worth of sales in the last financial year, which is phenomenal from a almost standing start 4 years ago. If we can, and our asset is still sitting at $27 million. So we've got a fairly strong asset base. Can we go to the next slide, please? Okay, so as I mentioned, these are the different verticals in the business. Obviously, property sales, property management, and the ancillary services, which covers from financing to insurances. But one of our point of difference is our platform. We work on a hub basis, so we don't have offices in all the suburbs. And the support for all our agents is centralized in the hubs, and they work off a cloud-based platform. Now, during COVID, this proved particularly a benefit and an advantage. It showed that we had no slowdown or disruption with our workflow and our agents, and kept providing them the service they needed to try to carry out their business. What it did also show to the industry is that you didn't need offices in every suburb or to be located in an office. Okay, next slide, please. That's our national footprint at the moment. You can see it's dominated in New South Wales and WA where the business started. We've now finished twice as the largest office in WA in terms of sales and volumes. And even more importantly, is that we're ranked #1 in the premium suburbs in the east coast of the lower North Shore and the eastern suburbs. And we've also got a very solid base in Victoria that we've just kicked off. Sorry, next slide. Okay, so if I can just keep talking about our results that finished in the financial year 2020. I think this is a good graph because it actually just shows you the scale of growth and the return and the growth they've been having in the last 4 years. So it's been, you know, in excess of 20% in all the key indicators in terms of revenue, gross commissions, listing numbers, and values of exchange, and how our property management, which is in the bottom left corner, has been growing at a rate of 12%. Next slide, please. Okay, this focuses on the September quarter. And again, it's important for us to show what happened when COVID hit and now what's going on post-COVID. So you can see that in the previous quarters, we were always had a growth trajectory. COVID hit, unfortunately, in the March and June quarters when things got shut down and slowed down. We had a great response by our staff. Everyone chipped in to assist the company and get through the COVID crisis. We had people that volunteered for wage cuts right across the board from directors down. So it was a fantastic effort by everyone. And then out of COVID, we've really jumped out of the starting blocks. And you can see in the September quarters, you know, growths of 49% in terms of revenue. Again, in terms of GCI, 50% number of listings. Now, the other point I want to make here in terms of the number of listings, the actual total number of listings in the country isn't in fact growing. This is more the case of our agents actually grabbing more market share with the branding and the systems that they've got. Also, you can see the strong sales quarters. I can also say that this trend is continuing. Our November numbers look very strong as well. And with all indications and with the Reserve Bank decision also being made this week, I think these trends will continue to grow all the way to Christmas. Next, please. So this is what I was talking about, the trifecta that we got. So I just went through our financial numbers and the strength that they've given the company. In terms of our funding, this was one issue that the market was really wanting to us to get under control. We had a situation where our funding was coming up every 6 months and it was causing anxiety in the market, especially during the COVID period. So what we managed to do is we managed to attract a founding investor in Bob Peters, who's a prominent businessman in Australia and particularly in Western Australia. He's taken half the debt off Macquarie Bank under a con note. And so that gives us a strategy to reduce that debt into equity. We've also sold some of our rent roll to help reduce that debt as well. And Macquarie Bank has also come to the party with us and committed to be our primary banker for the next 24 months. So I think that's giving the market a good indication that now we've got a solid foundation. We've reduced our liability position. We've still got a strong asset base and we've got a very strong supporter in Bob Peters and Peters Investment. Next slide. So, and this is the third part of the trifecta. Towards the end of the quarter, we actually formed a joint venture with a company called Managex. Managex is chaired by John Poynton, which I'm sure we all know, who's on the Future Fund board, and with Kim Slater as managing director. Managex has put a fund there at the moment. I think the funds are around $60 million. And their objective is to go out there and buy real estate businesses to get a hold of their rent rolls. the joint venture is fantastic for the agency because what it does, it has a license agreement that we've given to ManageX. So all their managements will be licensed under the agency. We also have exclusive agreements that we will refer in WA our property management referrals to ManageX, and they will refer all sales leads back to us. This will do is means that we can grow our sales part of the team without us having to raise funds or make the acquisitions ourselves. So ManageX will go in there, buy the business, take the rent roll part. We will let them sit down with them and look at settling down the sales part of the business and any other part of the business into the agency part. But all of it will be branded the agency. So it's a great result for us, and it's initiative we are starting to roll out, and you'll soon see some results coming out of that as well. So in summary, we've achieved three things, and on top of all that, I think we've still got a lot of upside in growth. You can see that we started, we've got a good beachhead in Victoria, but those September numbers, I also should add, was pretty much without anything coming out of Victoria due to their shutdown. So now that that's opened up, the next quarter will include sales figures coming out of Victoria, which will add greatly. But you can see that we've got other markets to still attack in terms of Queensland and South Australia. And we've also got other verticals in terms of commercial property as well. So I think we've addressed the market in terms of our debt, our asset position. We've now proven that the model works and is scalable and is producing profitable results. And so I'm looking forward to hopefully getting a re-rating. Thank you.
Thanks, Paul. I mean, it's fascinating, the real estate market. It just continues to boom. Can you just talk a little bit to your rent roll, how that was affected during COVID and whether that's improved?
Yeah, and it's funny because it's different from state to state, Tim. So in WA, it held on fairly strong. And you can probably, we actually are going through quite a tight market at the moment. So there's almost like 1% vacancy. So that pressure was coming up through COVID anyway. And yes, there was deals done with people to reduce the rental pressure, but we lost very little from that. New South Wales, it got hit a bit harder because of the capacity there and the availability of properties, but even that's now bounced back quite strongly.
And the rent, you've sold the West Coast rent roll and you still own the East Coast rent roll. What value do you put on that East Coast rent roll?
So we've had a valuation that was conducted by an independent valuer. It's still coming around 27 million. So it's quite a strong value asset for us.
And that's against debt of, what was the previous?
Well, now effectively, the bank debt will be 5 million and the con note's 5 million. But as I said, that's the process now to reduce that into equity.
Yeah, I mean, you can see where that re-rating could potentially come from. Can you also give us an update on the Victorian property market, given the lockdown conditions there?
Sure. Well, as you can imagine, that sort of put a block on demand. And now that tap's opening up, it's coming out quite strong. So we're seeing some quite strong results and auctions being booked in Victoria. And I think that'll continue for the rest of the year into December. Okay,
another question here. With rising unemployment and job insecurity, is the composition of your sales changing? Will that alter your growth emphasis to particular states or activities?
Yeah, look, again, it comes down from state to state. The unemployment market in WA isn't changing. It's actually firming here. Yesterday, in fact, the government was talking about it getting a bit too hot in WA. So I think we're going to have an environment where, again, with the interest rates just being lowered again, strong job demand or employment, we're going to be in a very strong market. I think in New South Wales, the government's taking actions there also to with infrastructure projects to keep the employment level up. I think at the moment, the indications are that the market's going to be strong because of the low cost of money and the jobs that are going to be created.
And do you see that growth in your pipeline? I mean, real estate always works off a pipeline.
100%. That's a great question, Tim. I was speaking to Matt LaHood yesterday. He was telling me there was already 55 auctions booked for December in Sydney. And
what's that usually in terms of average?
Oh, in terms of average, look, it's still early on, so we expect a lot more, but it's well up on the previous months. So I think we've already locked in probably more than 60%. Great, thank you.
Okay, look, we'll leave it there, Paul, but always appreciate your time, and it'd be great if we could get an overall update on real estate market from the agency for ShareCafe moving forward, hey?
Thank you, Tim. Thanks for the opportunity.
Great, thanks, Paul. Next up, we might have to check my pronunciation here. Nanolos Limited, ASX code NC6, market cap only small, around $7 million. The company is an Australian-based biotechnology company advancing innovative technologies relating to the production, processing and applications of microcellulose. I'm going to introduce Alfie Germano, who's the CEO and Managing Director. I've looked at your website. I think it's fascinating what we're about to talk to, so I'm going to hand it over to you. Thank you.
Oh, thank you, Tim. Can you hear me?
Yes, all good.
Oh, fantastic. Oh, good. Well, good morning over people from West Coast, and good afternoon, people on the East Coast. I thought I might start off with just a little bit of an insight. As we head into what is essentially a post-COVID or even mid-COVID era, leading companies are starting to rethink their future state. And rather than debate what's changed, let's just agree that things have changed and things are evolving. And one of the joys of my job is I get to speak to a myriad of different people in various sectors around the world and also here in Australia. And what I hear is very vast, but what I see are 5 clear pillars of change and opportunities to consider. And they are embracing technology, a commitment to quality, value versus price, transparency, and sustainability, of course. In our space, we're seeing brands and market leader retailers pull away from their competition by doubling down on most of these pillars. And this has resulted in customers who pay a premium for their products and also remain loyal, which I think are 2 massive wins in this day and age. So this dynamic, what I like to refer to as zeitgeist, allows Nanolos to develop within, because I feel that we touch upon many of those pillars. So to kick off our story, to the next slide, we've got a video to show you that adds a little bit more colour.
Ever wonder where your clothes come from or how they're made? Today, millions of trees are harvested globally and chemically treated to extract a raw material called cellulose, to make a fibre called rayon viscose. This practice has heightened environmental and sustainability concerns. Nanolos, a future tech biomaterials company, has been advancing 2 distinct technologies and establishing a supply chain to produce a greener raw material and textile fibre. The first technology takes liquid waste from food and agriculture sectors and grows this into a high-yielding cellulose without trees, that in turn uses considerably less land, chemicals, energy, and is highly traceable. This cellulose is tree-free. The second technology is then regenerating the tree-free cellulose into the company's breakthrough fibre called Nullarbor that has been spun into yarn. This yarn can be made into fabric to produce garments using standard and advanced manufacturing machinery, limiting the need for further investments, time, and retrofitting costs. Nanolos has already signed supply and development agreements with 4 key industrial and global manufacturing partners that bring experience to the commercialisation and supplying of Nullarbor to uptakers in the textile industry. The significance of the nanolose technologies is that they provide a solution to a number of ecological problems, along with being able to supply the increasing customer demand for greener options. The nanolose tree-free alternative and nullable fibre has generated significant interest globally as consumer sentiment drives change and companies look to bolster their climate targets and greener products. The mission is to build a technology and ecosystem that will produce large-scale amounts of raw material and fibre with minimal environmental impact for our future partners and create a sustainable revenue stream.
Yes, over to the next slide. Whoops. Thanks for that. We back on now, Tim? Hello.
Yeah,
Hi.
all good, Alfie. Keep
Thank
going.
you. Thanks, Tim. So I think we'll start off with just our corporate snapshot. So ASX code NC6. I have 117 million shares on options. Share price has gone up since last week. We're at 5.59 with a market cap of nearly 7 million. And we have cash at the moment of about $500,000. And at the moment, top 20 shareholders at 34% of the company, and of the board and management remaining 15%, which is a tight structure. Our cash burn just on this money page here, our cash burn has reduced considerably since I want to say April this year, where we've had several restructuring of contracts with various vendors and what have you. Management did take pay cuts and what have you, and this has all been compacted down to a much slower burn of about anything from $80,000 to $90,000 a month. Can I have the next slide, please? So investment highlights, again, on this page here, we have been working on a scalable, what we believe is a revolutionary fibre. We didn't raise this money to stay small, as like I always say to people, we may start off small, but we're definitely moving towards getting it much larger. This is what's demanded by our customers. We signed a collaboration agreement. In the video, you would have heard two technologies. There's the growing of the raw material, and then there's the making of the raw material. The making raw material, which is the technology part of the business in terms of converting the raw material into fibre, we were able to sign a collaboration agreement with arguably the world's largest rayon maker in India called Grasim, who are also called Aditya Birla, and they are helping us to accelerate the commercialization of our fibre. We had also strategic partner investment just recently with part of a capital raise with a group out of Queensland called Celluair, which is wanting to take their nanocellulose and putting it into higher grade filtrations and masks. And also we've signed an agreement last year with Coty, which is a B2B company making high-end wipes, personal wipes and all personal hygienes. And then also this is all part of the all-encompassing taking our raw material, developing our IP suite. Nanolose has also Nanolose has developed a technology that impacts many factors, which I'll get into later on in some other slides. Over the past 18 months, we have been advancing our fibre. We're going from initial lab trials to much larger trials to now pilot trials as we're moving towards initial production trials. We made our first garment last year. Which is the world's first rayon garment made out of completely no trees at all, which we've trademarked tree free. We are a pre-revenue company. I like to say that when we first started the company, it was 70-30 R&D versus D, which I think is now flipped. 30% is R and 70% is D and growing. And needless to say, the kind of things that we do has attracted many people in the textile and fashion space, which is my background. I'm actually up to about 32 years in that space. Next slide, please. So how do we do this? Okay, today we procure from trees, which we'll talk about in the next slide. So we simply take liquid waste of feedstock from food and beverage companies, and we inoculate it with a bacteria that Mother Nature does all the work. grows this bacteria. We're learning how to purify that, and then also take that pure raw material and then move it over to fiber making. And then when from fiber comes from yarn, and then from yarn comes into fabrics. The significance is, next slide, please. So today, all cellulose comes from trees. So when we're talking to people and saying, did you know that the yoga pants that you're wearing come from trees? Most people are not sure. There's 5 actual textile pies in the world, with petrochemicals being the largest, then cotton, then trees, then protein, and then now what I call alternatives, the things that are made out of the labs. But if we just focus on us versus them, so today all cellulose comes from trees. So we take trees, we cut them down, we chemically extract them, we get this cellulose, tree-based cellulose, and then it goes into an infrastructure. The difference between us and them is that we're not cutting down trees and we're not even chemically extracting it. So we bypass almost 3 parts of the whole process to arrive at a tree-free cellulose. And Nanolose has been designed to work with the current infrastructure rather than change the fiber factory, where we're providing an alternative feedstock, but also an alternative synthesis rather. And what that does is, by doing that, you avoid large things. For example, there's no forestation, there's no wood pulping process, low energy, low pesticides, low water. And one thing that gets me very excited is that it takes 12 to 18 years to grow a tree. It takes 6 to 8 days to grow microbial cellulose. So if we look at the intensity of growing in terms of vertical farming, what have you, in our new forest technologies and concepts of growing this, we're able to intensify that. So the yield per square meter is off the charts. Next slide, please. So here is just a nice glossy picture of it. What you see in the beaker there is waste from coconut. It's been fermented, then it's dried into fiber, and then it's dried into flakes, and then it's made into fiber, then spun and made into a garment, just to provide you a snapshot of how our process and our technology has been validated. The next slide, please. So clothing, we are very proud of our fibre. We've called it Nullarbor. Everyone thinks it's because we're Australian. That's only part of it. Nullarbor is actually Latin for no trees. The rayon market is growing exponentially with a CAGR, I think, of about 7% plus every year. The reason for that is twofold. One is demand, and the second is that there is just a shift from, say, traditional buckets, for example, petrochemical and cotton, over to more what is considered more sustainable avenues and alternatives. So if we take what we have right now, which is about $16 billion versus to the projected nearly 21 billion, there's a large space to play there. So by not even encroaching on the current supply, we feel like we can carve ourselves a very nice piece of the new, or what I call the new alternative, or the new demand. And then from that, we're able to work with our partners in India so that we can scale with them, as they are the largest in the world. Next slide, please. So when we're making fibers is one thing, Neufolium is the other. Our fiber is able to be blended, so we're able to increase our yields. Neufolium is also a fiber that we have been working with other alternative cellulosic inputs, so that we can address other customer needs, of which one is, for example, personal wipes. There's a lot of personal wipes. It falls into a space called non-woven. Most of the face masks that we wear today are also non-woven. So this gives us an avenue to work in there from not just a yield standpoint, but also a cost and engineering standpoint. Next slide, please. And as we're diversified, so the shift has actually begun. I mean, 3 years ago, when I were on road shows, people are asking me, do people really care? Is it really, really important? And then over the last 3 years, we just see monumental fashion brands and retailers publicly criticizing themselves and putting their ESGs targets in front of the public eye and holding themselves accountable. We have multiple NDAs with various brands and retailers around the world, and we continue to get more. Our focus is fiber first. We want to make fiber and deliver that fiber to these brands. And we probably cannot go and have a whole blunderbuss approach to it. We're going to be very strategic about the brands that we speak to. We want to speak or collaborate with between 1 to 3, and in various pockets, for example, outdoor or lingerie or fast fashion or high-end fashion, which is my favorite. Next slide, please. So just a little bit about our collaboration agreement with Grassam. Like I said, they're a part of a big conglomerate out of India called Aditya Birla, which is about a $49 billion company. Rayon and textiles is about 5 billion of that. We signed an agreement with them in January this year. I think it's a match made in heaven, as their biggest goal is to reduce the cellulosic inputs that come from trees and look for alternatives. And Grassam continually kicks gold. There are some world authorities like Canopy Style that monitors and puts grading on what they call the green shirt or hot button of these companies. And Grassam continually kicks those goals there. So what they say and what they do are aligned, and we're very, very proud to be part of that association and develop this with them going forward. Next slide, please. Coyote Collaboration Agreement is a B2B customer that works with some of the largest European wipes and manufacturers. Coyote is that the second last chain in the whole chain of taking fibre and making products. Again, another group of companies that want to see a better world and want to start buying alternative feedstocks, and that's where they see us as a potential advisor, a potential provider, but also innovator in this space. Next slide, please. We recently had a capital raise, and which came with also a strategic investment with Celluair, which is a group out of Queensland in conjunction with another company called Innovise. Celluair is making steps towards advanced filtration technology, and also when we talk about filtration technology, it comes in various parts. It could be a mask, it could be the filters inside a mask, can actually be filters inside the hospitals, for example. Not to get too technical, but the raw material that we have has some very amazing properties with regards to filtration, water absorption, and also to be pyrogenic and antimicrobial. So we felt that there was a synergy there, and what the beautiful part about this alliance is that we don't have to make fibre to give to Celluair. We can just keep it in a raw material. So it just gives us another pathway to commercialise from a raw material standpoint rather than a fibre standpoint. Next slide, please. So how are we all going to do this? So it's a three-part process. So for example, we have to increase supply. Up until now, we've been doing it in double digits. We're going into 3 digits in the tonnage. We have agreements with 2 groups in Asia, one in Indonesia, and the largest one being in China, to provide us initial amounts of microbial cellulose, working with them in conjunction on how to process it and have that to be industrially ready. When that's industrially ready, the more we make, the more we can pass to our industrial partner in India to take that and make it into fibre. And once that fibre is made, then we start engaging with the exclusive agreements or manufacturing agreements with commercial partners on the tertiary part of our business, which is basically the brands and retailers that are at the forefront from outdoor. I won't mention names, but you can kind of figure it out. The people that are champions in this space, from sports active to athleisure to outdoor to lingerie to ready to wear and so forth. And because of that, we'll go into the next slide here. It shows you what our news flow catalyst will look like. We believe that we're going to be able to do all these things here between Q3 and Q2 of next year, where COVID has had an impact on our business in as much that it has slowed logistics down. To move things around has been difficult. What used to take a week in China used to take 3 weeks, even though now that things are improving and returning to a new norm, or prior norm rather, where we feel like we can play some acceleration games there to do that too. So we're confident that we're going to be able to make tonnage, provide it to India, make fibre, and commercialise with a brand and a retailer in the next 3 or 4 quarters. Next slide, please. And I think that's the end of it. Yeah, this is my favourite part, where I get to say everything I said I didn't really say. So any questions, please, Tim, bring them forth.
Thanks, Alfie. I think you might have a phantom typer in the background there. There's a little bit of a tapping, but let's talk about the no tree rayon in terms of pricing. Does it command a big premium, or how does it compare with traditional materials?
Yeah. Well, we're nowhere in the industrial norm of what the tree fibre is at the moment, Tim. I mean, that's just purely on scale. Wood pulping has been around for 120 years, and I like to think we've been around for 120 days. But what we have seen in the past 3 years, that it's halved, and halved. And we believe that in the future, when we have our own dedicated growing spaces, we'll bring that down. One thing that's important to highlight here is, I don't think I'm shooting myself in the foot when I say this, because our industrial partners are very comfortable with these statements. We may never be the same price as trees, but we may never ever sell to the same people that pay those things as well. So we probably can't provide a $6 t-shirt, but we can provide a $50 t-shirt, for example. So there's so many different pricing brackets and so much margin elasticity. So we want to work, that's why we're saying before, we want to work with the people that are in that middle to high space that accept that. They're quick adopters, and they're also very, very quick to invest in these spaces. So that's not the thing that keeps me up at night.
No, Alfie, thank you. I understand it's a scale issue. Now, a question here in regards to, you know, the safety aspects of the product. Once it degrades, is there any nanoparticle risk? Can it be recycled, composted, etc.?
Because it's 100% cellulose, it's compostable. It actually composts quicker than cotton if you put it into the ground. Rayon per se naturally has an antimicrobial element. It's not something that you would untreat and put on a surgical bandage, but it does have an antimicrobial and antibacterial infrastructure in its fibers. As far as being recyclable, I believe that it is. We've had conversations with people in our own space that are into recycled technologies, and we believe that if they're able to recycle cotton and rayon, you'll be able to recycle our fiber too. Our fiber is going to be on the same par as rayon and lyocell. So it's not like it's completely different. It still has the same characteristics, and it's going to be regenerated the same way. And what I mentioned before about the market shifting in terms of the pie chart, that's where rayon is expanding as there's a demand, not just because of the softness and what have you goes into athleisure, but because rayon is biodegradable. It is seen as a better fiber to say, for example, as a polyester alternative for the time being. And
now, just one more, I didn't give you a bio, and you've been in the industry, the global textile industry, for about 30 years, right?
Yeah.
And that is an industry known for waste. Can you tell us what attracted you to this technology and the business?
Oh, thank you. Yeah, I started the business when I had really a lot of hair. Paul Neodoni would probably tell you that. I lived in Hong Kong for 25 years. I worked for the world's largest textile companies, and sustainability was something that was always on top of mind. I guess as you get older and you look at the analytics, I just wasn't comfortable with the fact that we're the second most polluting industry. And you hear different arguments, but it's not great. If we're not the second, we're the third either way. What interested me about Nanolos is that it's a completely alternative feedstock. We're not trying to recycle polyester. There's lots of champions in that space. We're not trying to regenerate new cellulose out of, for example, cotton shirts. There's so many people in that space here. But I've been lucky. I've been looking at all these innovations through my career. I felt that this in particular has legs, because you're taking feedstocks that are currently either destined to water treatment or into landfill, and getting an alternative. So, you know, how much milk? I'll give you an example. Working with one coconut processor in the Philippines that produces 2 million litres of coconut water per day. What happens to that now? That goes straight into water treatment. So these are the sorts of things that I get excited about, to saying we can completely have an alternative source to make a fibre, and therefore, because we can have a source, I mean, it'll positively impact other places. So we can cut down less trees. And, you know, one thing about trees that people, I can tell you this straight up, is that the best tree is not to cut it at all. If it's already 12 years old, it's going to be sucking carbon out of the air better than saying planting another 100 small trees. So leave the trees alone, and this is just a positive impact too. And the other thing too is coming from the industry that's screaming for alternatives. There's a new retrospective thinking. There's a new zeitgeist that's coming. So I figured, as much as this industry has given me, it's time to give back. So that's part of one of the drives. I might sound like a bit of a hippie there, Tim, but that's the truth. Yeah.
Thanks, Alfie. I mean, it is the investment industry is certainly driving interest in these sort of sort of technology and this sort of sustainable product. Yeah. So thank you for being involved today in the webinar.
Thank you.
I'm sure we have time for, but good luck out there. A great story.
Thank you. Thanks, Tim. Thanks, everybody.
Thanks, everyone. See you next week. We've got 4 or 5 companies already lined up. Thanks again for your time. See ya.